In this episode, we're going to talk about a client of ours, a chiropractor, who is leveraging his policy, his whole life insurance policy, in the right way, the smart way. We're going to unpack his story. We're going to also unpack some of the nuances in the story, and how to use this particular structure, and how it's actually going to allow him to achieve his goals faster than he actually anticipated. So let's get into that. Kyle, fill us in specifically. This chiropractor client of ours has a whole life policy, but where did that story begin? Like, let's start there, and then let's unpack how he's using his policy today to buy the building he originally came to us to help structure around, and how that's actually going to help. And then also, what are some of those next steps we'll get into that we gave him as a here. These are the things you might want to consider while using this policy to help you kind of go forward.
Yeah, absolutely. This particular client was originally a listener of this podcast, so they probably are going to recognize this story a little bit. Ultimately, they came back, and we actually started discussing and strategizing back in the spring of 2024. So, things that are really important for people to note is that, it does take some time to actually craft and create a holistic plan that is going to help you not only with your corporate wealth management strategy, but also personal wealth management strategy as well. So it did take some time. And then by about November of 2024, a policy was put in place. And initially, the thought was that there were plans to buy the building. Now, this isn't like a new idea. We actually, in the very last episode, we talked about a medical doctor who actually sold the building they were operating in when they were winding up the company and they were ready to kind of move on and do, non-work things in their life, that thing we call retirement. Well, with this individual, they've been leasing the building, and over time, they have had some conversations with the owners of the building. There were some severing issues with the property. They needed to get some, zoning things taken care of. And it was actually thought that it was going to be a number of years before they were able to purchase this property. It's one of the greatest assets that you can purchase. First of all, the tenant, it's you and your business, right? You get some exposure to real estate. You get, that physical aspect, and you feel like you're taking some of that flywheel cash flow that you've been building in your operating business. And now you're able to sort of start the investment side of things while it's still helping your business. Because guess what? You're the owner. You get to set the rates, and we can be strategic about how we set things up and how we do those things so that you're not triggering unnecessary taxes, and you can minimize things, and of course, benefit from the growth of real estate as an asset class in general. So that was the game plan. However, we did a check-in call recently, and now, we're talking spring 2025. So only about a half year later. And all of a sudden it was like, oh, shoot, things are moving along really, really well. The owner of the building had called and said, like, we might be able to get this thing closed by, maybe December 2024, might be a little bit aggressive, early 2026, which is vastly different than what we were actually planning for when we had set things up. However, because of how we set this plan up, he's in a position where he can leverage the liquidity of the cash value of this corporate owned life insurance policy, properly structured, to assist in the purchase of this building.
So, in the Wayback Machine, he originally came to us knowing that he wanted to make use of this type of structure, knowing that he was going to buy that building, and wanted to use, say, the retained earnings that was inside his business every single year. It's like, let's put it to good use. Let's start building cash value inside the corporately owned insurance policy, with the purpose of leveraging against that cash value for the purchase of this business at some point. And so he's got 2 years, because he backdated this policy. He's got 2 years of cash value before this year. That's now, say, accumulated, where it's now sitting, at this point where now it's all of a sudden this is upon him, where I now have to decide, do I buy the building or do I not buy the building? And it looks like when he peeks into the cash value of this policy, he's got enough, say, to buy it. And because he was proactive, right? He was thinking in advance of making use of this structure for this exact purpose, which was great for him to, like, set himself up this way. This is like, he's established his corporate reservoir, right? He's built this over the course of 2 years or a year and a half of cash value, so that it is his opportunity fund. It's his wealth fund where he can go and buy this building for an asset that it now is going to add to his wealth. And that's where he is. And part of it is, that corporate wealth reservoir is what we call stage 2 of a healthy wealth planning system. And this client was really proactive in establishing that, which in order he had to also get clear on what stage 1 is, which is what does he want to, where does this vision go? Like he had this very clear pathway of, I'm going to be buying this business, it's going to do this, and then it's going to do this. And so we helped him kind of clear there, but then helped him establish the corporate reservoir so that when time came, he could buy it. And that's where we are today. Now, here's some wondering here specifically, because I know that the conversation was, all right, Kyle, help me leverage the cash value of my policy so I can go and buy the building. And I think you said, wait a minute, let's talk some options here.
Absolutely. So, it's interesting too. I think worth noting is that before the policy had been, crafted, created, and put in force back at the fall of 2024, the dollars that were utilized were actually being invested at the time in a GIC. So something worth noting is there was not only a conservative sort of, I'll call it, we'll call it hesitation to put funds into anything too risk on, simply because there was a plan in place. The plan is, I do want to eventually buy this building. The building is going to be the risk on asset. And in the interim, just like anyone who's starting out in the investment space, when they're doing real estate, usually you don't take your seed fund and put it into, the stock market, as equities, because when you go to buy that perfect property, if the market's down, things don't work out so hot. So had it in GIC. So it was earning a pretty conservative rate of return, but then losing half of it to passive income taxes. So that right there was a big loss. The longer we do that, the more we're compounding this, half the interest amount, obviously the less growth he will have in the interim, but he still wanted that safety. So the policy provided that. However, what we weren't anticipating is requiring that liquidity so soon. And I think the lesson to be learned here for everyone is that actually, as soon as we set up that policy, there is some cash value available that can be leveraged either through the insurance company or from a third-party lender. Now, third-party lenders aren't going to really want to get involved unless there's a significant amount of cash value, right? Big banks are going to be looking 250 and up, and, some private capital firms might do a little less than that. So, relying on the insurance company for short-term needs is probably going to be the easiest mode, because it is contractually guaranteed that they will offer this policy loan, which is great. And basically what ended up happening here, and, because there was so much money in these GICs, we offered the idea of backdating the policy a full year. Now, John, you had mentioned a year and a half of compounding growth. It's you almost get fake time happening when we backdate a policy, right? Because what we're doing is we're saying today, we're recording this June 17th, we're saying June 17th, 2025, I'm going to put this policy in force, but I'm actually going to let you pay for last year's policy. So we're going to say the policy went in force June 17th, 2024.
Right.
And therefore, you're going to get 2 years of premium in, and therefore, you're sort of supercharging the cash value growth and what you have available and accessible to you. So this policy was fairly significant for this particular business owner, specifically around having an opportunity fund, this corporate wealth management bucket, or this corporate wealth reservoir, as we like to call it, so that he can then make other investments. And let's not forget, every operating business needs emergency cash flow. We need it for capital expenditures. We need it for improvements. We need it for dry times in terms of the actual operating income being low within a given season, for example. So there's a lot of that aspect here as well, in keeping liquid cash. Now, we were supposed to have more than enough cash in the cash value available to purchase this building in a few years' time.
Hmm.
However, when we look now, we go, this building, which I believe the purchase price is going to be somewhere around 750, and we're going to need that money by, early 2026. We are now looking at cash value and we're saying like we're actually almost at the 750 mark just based on the first 2 years worth of premium. It's going to be a little short. However, come November, when he pays his third year premium, he will have more than enough cash value there that he could literally just say to the insurance company, I want a policy loan for 750 or 750 plus closing costs or whatever it is that it ends up being, in order to slap that money down on this building. And he owns this building, this property outright, which
Right.
feels pretty good, but
Yeah.
it's not really necessarily the most efficient or optimal way for this particular business owner to go about it.
Right. Right. Because you're in a way, in investment purposes, what you're saying is like, even though I do have say liquid or capital available to leverage, I'm going to borrow it all, and and that's where this is going to come from. And it's like now what you're now in thinking about, and this is where I was thinking about, is like, okay, if I borrow everything from that, does that pull all of my liquidity away? Like, do I have enough for where is my reservoir now? Like, is it like the whole point of
Your
establishing?
reservoir is dry.
It's dry, right? Exactly. It's like the whole point of the policy was to have the reservoir for emergencies, but also for investments. And so, in his case, if he pulls most of it, even with his third year policy premium payment, he's going to top up and take out the loan to say put down on this property. Now you have own 100% of the building,
Amazing, by the way.
which is great. Now you could start to get where's my reservoir? Is my reservoir completely dry on the policy side, or now do I have like equity in the building? Is that now going to be my reservoir? And if so, am I gonna like borrow from the building's equity to do something when an emergency comes up? And then my wonder is like, is that too complicated? Like I'm borrowing from one lender to buy another asset, but then if I need to, I'll borrow from that new lender over on this side. So now I'm wondering, is like, is there a way for this client to go, I have my liquidity over here. Maybe I want to use some of it and not own 100% of the building. And maybe I want to go get a mortgage on this building and use other people's money to start doing, that type of thing, instead of losing all of my liquidity in the process.
Yeah, 100%. And, I just want to make it very explicit for those who are listening. I'm understanding, like, John, when you're saying like to own 100% of the building, like you're talking about having like 100% equity in the building,
Right.
like there's no other lender.
Well,
We always like to
you've got
sort
the
of
lender over there that you borrowed the money against.
Exactly. It's like, guess what? When we do have a mortgage, the reality
But
is,
there's
like, you don't own the whole building, even though your name's on title. It's like that
Yeah.
bank, you're a business partner with that lender.
Here's the nice thing though, is like there is no lien on the building, right? Like you didn't register a mortgage to the building so technically, yeah, you own it. You just have a loan over here. So your net worth is no change. But I mean, you still owe that money to the lender of your policy. But
Exactly.
you had the liquidity there to like do that if you needed to.
100%. So, and I think you've highlighted exactly where my head goes. Is I always look at things and a quote, I don't know who it's attributed to, but I've heard it a number of times being said, and it really sticks with me, is that, lenders are amazing at offering you money when you don't need it, but they're really, really bad at lending you money when you do. And that is exactly what we don't want to happen here, which brings us back to the idea as to why a corporate wealth reservoir is so important. This is true personally as well. Like our financial wealth and health system is applicable both corporately and personally, right? Like personally, it's like an emergency fund, right? The same would be true if I was buying this and I was an unincorporated individual. I want to keep that liquidity there. I have the same amount of quote unquote debt, but my net worth is the same for now. However, there's some other benefits here that we can talk about as to why I might recommend us leveraging the building with a traditional mortgage and only leveraging the policy for the down payment, closing costs, and all of those things. And it really is exactly what you've alluded to, which is Guess what? Where can I get the money from easiest? And the reality is it's going to be against your policy, because I do have the actual insurance company that I can go to and say, I would like to borrow up to 90% of the available cash value, right? Now, if I've already have a policy loan out, I can't take 90% of what's already gone. So that portion I've already, accounted for. I've already lent and borrowed, but I do have more left over, which is really, really important, because once again, why did we have money in GICs in the first place? Why did we have money in a low interest, or we'll call it a high interest savings account, but let's be honest, they're all low interest bearing savings accounts. Why is it under the corporate mattress, as we like to say? It's because we want to have just in case funds. And when I own a building outright, the money is trapped in the walls, and until I get fully underwritten, I will not see that money. And it's like, when cash flow is tight, that's when they're going to underwrite you. And that's when they're going to say, guess what? It's not really going to work because you're too tight because of X, Y, or Z. So keeping that liquidity is so key. One other thing that I think is really helpful here is by having that mortgage, and I'm going to assume, let's say, a 70% loan to value mortgage. It doesn't have to be, though. It could be 50% if you wants to keep it lower. It could be any number, but typically 70% loan to value with at least a 25-year amortization on that mortgage. So paying it back over 25 years. By doing so, what you can also do, if we buy this building and say a real estate holding company, or just the holding company that this individual may have, what we can do is actually have the operating company renting or leasing the building from the holding company. And the part that I like about this is that we can decide on an appropriate lease and triple net sort of, paying for the expenses and all of those details to try to net out. Meaning we can have an expense on the operating side, because we're going to pay for all the expenses in the holding company. We're going to send that over. We're going to pay the mortgage. We're going to pay the utilities. We're going to pay for the insurance and the property tax, all that fun stuff. But we're actually not going to try to have any profit in that holding company. Why? Because we're going to lose 50% of it to passive income taxes. So we're really looking for sort of like nice net benefit. We're going to get a write-off over here. We're going to get no passive income taxes over here. And we also have the interest on that loan that's easy to write off over in that holding company. Keeping that third-party lender there just makes the interest so much more, we'll call it trackable and easy to bookkeep for accounting, that we know that that interest was attributed to that specific building, which is an investment, and therefore we can actually write off that interest and not have to pay as much in taxation across the operating and the holding company, and we still keep more money in the corporate wealth reservoir for the next investment, right, for the roof that needs repair, for the air conditioner that goes, or for something in the operating company that we might need as well, due to maybe revenue being down or other unexpected expenses that we might run into along the way. I love that strategy, and I love that it keeps things going and growing without triggering any unnecessary taxation along the way.
Yeah. What I think one of the benefits here is that we always talk about like two uses for the same dollar. So because you're trying to optimize for making, say, a net zeroed out effect on your holding company by kind of making sure those expenses and revenue you're pulling between the two businesses balance, I feel like, and then also making use of, say, a third party lender, keeping more money in, say, the reservoir to optimize, maybe like you said before, another asset or your emergency fund, but specifically maybe there are other assets that won't gain or won't have the same investment return that this one has. Like, you're buying the building because you kind of need it, but it's also, there's a good investment there. But part of your strategy might be, I want to use a chunk of my reservoir to invest in other assets that are specifically higher return type assets. Because really, when you're buying the building that you're now going to try to balance out the return on, because you're not going to, you're getting some of that mortgage pay down. So you get some of that, that benefit. You're going to get appreciation on the policy, but you're not getting any cash flow inside the business to like balance it out, because you're the tenant. So So the return on that investment, especially if you went 100%, like you took all of that reservoir and put it down on the property and said, I don't need a third party lender, and I've used up my whole reservoir, but now I've used up my whole reservoir to do other things with, like buy other assets with better returns. Like if you went with a 70% loan to value, all of a sudden the amount that you put down on this property might give you a better return against your appreciation long term. But if you
100%.
went 100%, then, or like 0%, all of a sudden it's like your return is not going to be as great. So now you have this reservoir that you could say, like, I'm going to use 25% of the reservoir to do this with now. And I'm going to get two uses of that dollar because I can leverage against that and get a better return than what I was getting on my building.
I love it. And, it's funny because we have a different client, not the same one we're talking about today, who it was in April, beginning of April, in the middle of March, he requested a policy loan, and I can see that, so when it comes through. And I checked in on him because I knew what he wanted to do, and he wanted to invest a good chunk of money in just index funds, S&P, the Qs for NASDAQ, potentially some Bitcoin when there was a significant drop. And if anyone recalls, first quarter of 2025, what we had was a nice big drop of about 20%.
Sure.
So basically, he took this policy loan on this policy that he had been funding for, from the previous year prior. This was also a newer policy. And he took that policy loan to dump it in the market. Now, when I saw him take the policy loan, I did reach out to him and I just said, hey, the VIX, which is like the volatility index, is like really high right now. And I just said, just keep an eye on that, and you might want to wait till it starts trending down, but just a perspective, not advice. And you know what? He was like, don't care, doing it anyway. And he's like, this is my plan. This is what I plan to do. So he took a chunk, not the whole reservoir, by the way, and he flopped it down on the S&P. And if I'm pulling it up on my screen here, if I look at about where he got that policy loan, assuming he pushed it all in that day, he is now up about 22% on that investment. And we're recording this in June. So in 2 months, he's up 22%. Now, once again, not advice here, not recommendation, nothing
Right.
here. I'm not suggesting you do that. But to your point, John, is that if we took our entire corporate wealth reservoir and we utilized the whole thing to buy a building out full cash, I have now essentially put myself in a spot where I cannot take advantage of that particular opportunity, which this other entrepreneur actually did. Now, again, he set his corporate wealth reservoir to be there just in case, but also to take advantage of dips. That was like his plan. Love it. We don't do a whole lot of that, but I put it in my back pocket as an idea. The next time we see, like, what's the number? Is it 12% or more dip that you're willing to, leverage a policy, toss it in? Is it 20%? Like, what's your number? It's totally up to you. But the key is you have to have access to that liquidity in order to be able to take advantage of it. And of course, when you do put it in, you can't expect that you're going to be up 20% in the next 2 months. It might be the next year or the next 2 years. Is still a pretty good return on those funds. So just another example of how keeping the liquidity is so key for the just in case and the opportunities that maybe you didn't know were coming your way.
Yeah. Yeah. Some key takeaways here specifically for this scenario, and what we want you to kind of walk away with is that this client, had a clear vision. Their vision of their wealth plan was clear. We helped that clarity as well, so that we could establish the stage 2 component, which is your corporate wealth reservoir, and we proactively installed this for this client so that they could have access to this capital, which gave them flexibility. It gave him flexibility in making this decision earlier than what was anticipated because we had access there. Then we kind of strategically guided how to best use that corporate reservoir to make appropriate decisions, which is really stage 3, which is really optimizing your structures. I have now this really important structure, this whole life, corporately owned whole life policy that we've outlined many, many benefits on previous episodes, specifically here today too. Allowed this client to be flexible in deciding I could go over here for this type of loan. I could do this way. I could use it this way. You've created, this is the nice thing about this type of structure. and tool for your corporate owned reservoir, your wealth reservoir, is that it gives you a ton of flexibility. And so then those three stages of a healthy wealth planning system, this client is utilizing, making use of, and it's because they had that vision early on that process. Kyle, any other big takeaways you want our listener here to walk away with from this case study?
I think one of the big pieces is, it's really easy, specifically for really busy individuals. Like the more successful you are, whether you're a T4 employee, high income earner, whether you're an incorporated business owner, there's like these phases in life where you get into plan mode, but unfortunately it can be very, very quick and it can be fleeting. And with this particular individual, you'll notice it's like we started these conversations back in early 2024. We had planned this out. Plans change, and sometimes they change quickly. It's being nimble, and it's having a team on your side. And it doesn't have to be us. It could be other people that you're working with, but you have to find folks that you know, like, you trust, and you have to have a plan. It can't just be one phone call or one meeting and sort of set off to the races and we'll come back to it 5 or 10 years from now. You're sure to have changes along the way that are going to impact and influence things. This is a learning journey. And I think the part that I think is so critical and key for this particular client is that they haven't sort of arrived, they haven't sort of gone like, okay, I've done what I need to do and now I'm done doing the thinking about this work. This is part of the work. Part of the work in a business is to continue growing, planning, and building that business. The same is true in our wealth planning. We have to be coming back to it, and we have to be utilizing and sharing those changes with those you're working with so that we can help craft and modify plans as we go so that you have the best chance of reaching success, whatever success looks like for you.
If you want to structure, set up, get guidance around your wealth reservoir specifically, reach out to us at CanadianWealthSecrets.com/discovery. That's CanadianWealthSecrets.com/discovery. We'll hop on a quick discovery call, a discovery meeting to assess, where you are on your financial planning journey. And we're going to talk about that structure, that corporate wealth structure, as a pivotal tool that you can be using to keep yourself nimble and keep yourself flexible. Also, if you want to learn more about those 4 stages of your wealth planning journey, then head on over to CanadianWealthSecrets.com.
Just as a reminder, Kyle is a licensed life and accident and sickness agent with Canadian Wealth Secrets Incorporated. And a reminder, this is not investment advice. It is not legal, tax, accounting, financial, or any other advice. It is for entertainment and education purposes only.